Today, we're diving into a really strange puzzle in the financial markets, and all our data is coming from the Reflections of Reality Substack. See, on the one hand, the market looks unbelievably strong right now, but on the other, there's some serious warning signs flashing about what's coming next. So, let's try to make sense of it.
Okay, so right off the bat, look at this. The market's current setup is signaling an 85.2% probability that this bull trend is going to keep on running. That is a huge number. It basically means the way big institutions are positioning their money, plus the overall momentum, is screaming up. For now, it really does look like clear skies ahead.
But then, you see this number, 28.5%, just hanging there. By itself, it doesn't mean much, but I promise you, it represents a massive, massive disconnect from that bullish picture we just saw.
And there it is, that 28.5%. That's the chance prediction markets are giving to a military conflict between the US and Iran happening before 2027. Suddenly, that cozy 85% bullish signal feels a little different, doesn't it? And this is the core conflict we're unpacking today. A happy present versus a very scary future.
And that brings us to the market's, well, its split personality. It's almost like it's living in two completely different realities at the exact same time. So let's try to understand both of those realities, starting with the one we're in right now.
All right, first up, let's explore the world of the here and now. What are the charts and the hard data actually telling us about the market's current health? Well, all the signs are pointing to what the source calls a bullish kickoff regime. And yeah, we're coming back to this because it really is the headline story of the present moment. That 85.2% probability of things continuing to go up isn't just a guess, it's what the data is telling us. Right now, based on where the money is actually flowing, the path of least resistance for the S&P 500 is higher.
Now, this chart shows us why things look so good. See that spiky green line? That's accumulation, and it's sitting at 28.3%. In plain English, that means the big players, the institutions, are actively buying. Meanwhile, look at that tiny little red line at the bottom. That's liquidation, or selling, at just 6%. The so-called smart money is definitely buying, not selling.
And what's great about this map is it shows the buying is happening pretty much everywhere. This is a daily rotation map for ETFs. You can see this huge cluster of different market sectors, from industrials to materials, all packed firmly into that green accumulation box. This isn't just one part of the market doing the heavy lifting, it's a widespread vote of confidence.
Okay, but now we have to pivot to that other world, the predictive future. And this is where things get really complicated, because the forward-looking data is telling a very, very different story.
Our guide into this future is a platform called Polymarket. You can think of it like a stock market, but for events. People use real money to bet on all kinds of outcomes, from elections to geopolitical conflicts, and all those bets create these powerful real-time probabilities. It's the wisdom of the crowd, but with actual skin in the game.
So what is this crowd predicting? Well, first, a staggering 94.2% probability that Kevin Warsh will be confirmed as the next Fed chair. Now, why does that matter? Because Warsh is known for being a hawk, meaning he'll likely prioritize fighting inflation by keeping interest rates higher for longer, and that's usually a major headwind for stocks.
Over in the Middle East, Polymarket is pricing an 83% chance that the Hormuz blockade gets lifted by the end of May. Now that sounds good, right? De-escalation? But here's the catch. The source analysis uses the phrase temporary truces, permanent volatility. The market is expecting a short-term sigh of relief, not a long-term solution.
And this is the real bombshell. The prediction markets are pricing in these massive, almost unthinkable tail risks. A 28.5% chance of US-Iran military action, and nearly a 9% chance of a China-Taiwan conflict by the end of 2026. To put that in perspective, the source material notes these probabilities are 3 to 10 times higher than what you'll find in mainstream reports. And the stock market right now? It's acting like these numbers are zero. So, how on earth do we make sense of this? Let's take a closer look at this great disconnect between the market's happy-go-lucky present and its predicted, really perilous future.
I mean, here it is, laid out side by side. On the left, you have the world we're living in today. Strong buying, risk-on signals everywhere, low volatility. And on the right, you have the world Polymarket is bracing for, a tough Fed, huge geopolitical risks, and sustained volatility. They simply cannot both be right forever. Something has to give.
The source material from Reflections of Reality just nails it with this quote from its anomaly detection section. This isn't a small difference of opinion. It is a sharp break from what traditional analysts are telling you about both the future of Fed policy and the real odds of a major conflict. And right there, in that gap, is where you find both the opportunity and the risk.
So what does this actually mean for us, for investors and traders? How do you possibly navigate a market with such a split personality? Well, the source provides a pretty clear framework.
Let's break down the strategic table. The core idea is to sell equities into this strength. Use the current rally as a chance to reduce some risk before that hawkish Fed and those geopolitical threats potentially hit. At the same time, it suggests being long on commodities like oil and gold because conflict would likely support their prices, and long the US dollar, which is the ultimate safe place to hide. And with digital assets, be tactical. They've been tough, but those macro headwinds could limit how high they can go.
We can actually boil this all down to a simple three-step thought process. First, ride the current trend. You don't want to stand in front of a train that has an 85% chance of moving forward. Second, respect the macro risks. Don't be the person who completely ignores a 1 in 4 chance of major conflict. And third, and this is key, position for potential shocks now. Structure your portfolio during the calm so that it's ready for a potential storm.
So what you should really take away from all this is that one central question. Are we truly in a bullish kickoff, like the current data is shouting, with a long runway of gains ahead? Or is this just a calm, quiet moment before one of those massive tail risks becomes a reality? The data says it could, amazingly, be either one.
The only real way to know which of these two stories wins out is to keep watching the data. For ongoing insights and to follow these charts as they change day by day, you can find the source for today's entire explainer over at the Reflections of Reality Substack. Thanks for tuning in.